everyone, and welcome to Let's Talk Markets. I am your host, Pink, with my co-host, Dave Lauer. Thanks for joining us today.
Hey, Pink, how you doing?
Doing great. So this week, the comment letters for the most recent SEC proposals have been coming out, and Dave has been reading up on them and sharing his thoughts and some memes. But it's been interesting to see where certain interests align. Several of the letters so far have actually echoed the recommendations of we the investors, like the one from NASDAQ. IBKR brought up some good points, but there's been some notable opposition as well. Citadel and Virtue's opposition, I guess, comes as no surprise unless you consider their previous positions in the past few decades. So anyway, Dave, what are your thoughts as you've been reading through these comments?
Yeah, this is a really interesting time, I think, to be paying attention to markets. And these proposals they set out to really fundamentally reshape market structure. And in the past, when the SEC went to do this with Reg NMS originally, I wasn't really, I was involved in markets, but I was just starting my career. I wasn't paying any attention. I certainly didn't comment or read any of the comments at that time. I've since read some of them, but certainly Ken Griffin's Reg NMS comment letter, which we can talk about and which we spoke about in the last episode, but in which he said, internalization is one of the greatest threats to price discovery in financial markets. And we'll just keep repeating that line over and over again. But what I think, and having been sort of in this discussion and debate for the last 12 years now, I have seen alliances come and go, and I've seen firms sometimes shift their position. More often, I've seen people shift their position as they move from firm to firm. But I would say that, let's say 7 years ago, around 2015, 2016, there were some clear efforts by people to come together behind some of the ideas that have been proposed, most notably tick sizes, access fees, and even off-exchange trading. And you had firms like the New York Stock Exchange, Credit Suisse, proposed something that was called back then the Grand Bargain, which would have limited off-exchange trading, reduced the access fee cap, reduced tick sizes, everything that we're pushing for today. And Virtu is a big supporter of the Grand Bargain. And so, it's especially ironic, hypocritical to see that both the New York Stock Exchange and Virtu to be fighting these same changes that they were promoting really, not that long ago, 7 years ago. So all of that being said, I think that what we're seeing right now is fascinating because the industry, by and large, and there are lots of different segments of the industry. There are the exchanges, there are the retail brokers, and even within the retail brokers, you're finding a variation of opinion. There are the institutional brokers, there are the asset managers, there are the financial advisors, there are the high frequency trading firms, there are the wholesalers. You've got all these different segments of the industry. And by and large, I would say something like 90% of the comment letters I've read, and I've read a lot of them, as I was telling you, Pink, before, I have not taken great notes like I should be. I've just kind of been so excited to see these comment letters rolling in that I keep refreshing the page. I see a new one.
You're binging on them right now.
Yeah, I am, for real. And I want to see what they think. I jump in, I skim it, like, what do they think? All right. But I've sort of been doing this knowing I'm actually going to go through it at some point and take notes on how everyone feels. But what I've seen is I would say 90 to 95% maybe of the comment letters are very constructive and exactly what you want to see from the comment process, from the industry. There have been just an inspirational and massive number of individual investor comment letters that I think have shocked the industry, have excited regulators, have excited us, in the position that we're in. But when I'm looking at the comment letters now from the industry, and I think it's been fantastic. And even if a firm disagrees or an organization disagrees, for most of them, they're disagreeing in a very reasonable way, and they're saying either sort of like what we were saying, which is, we'd prefer these changes, or there's a lot of the disagreement is, hey, maybe this is a lot of change at once, and you should stagger the proposals so that we can make sure that they're necessary and that we can measure the effects. And those are very reasonable concerns to bring up. And then a lot of them are saying, hey, if you're not going to do that, here are some ideas on things that we would change or improve. So what I really see then from some of the retail brokers and the wholesalers is that they are extremists. They are out of the mainstream of the industry. And the way that they are pushing back is completely different than what the reasonable industry firms are doing. And I think that's not a surprise. But I do think they're really being exposed, both as we've highlighted for their hypocrisy, because they've all had different views in the past, at least the wholesalers, as well as the fact that one of the main criticisms that Doug Sifu, for example, has leveled at the SEC and at Gary Gensler in particular is that this is all politics. It's not data-driven. He's on a vendetta against them, silly things like that. And it's really one of those things where they're just accusing the other side of what they're guilty of. And I think it falls flat, and I think it's, their criticisms are very hollow. And we can get into some of the detail of Citadel and Virtu comment letters and then talk about, some of the firms that have come out on various sides. And I think that's a good exercise. But I really do think that the wholesalers and the retail brokers are on the very extreme end, and they are completely out of the mainstream industry thought.
That's interesting to hear, because I think, especially as retail investors, we may get kind of a jaded view of what, for lack of a better word, the other side might think, or how they might feel about these proposals, and we think that they would be more oppositional than they really are. So it's interesting to hear that it's been so, that they've put a lot of thought into it, into what's really best for markets if we're going to reform things, and to hear that, the majority so far have been positive.
Yeah, I love it. I love seeing some really thoughtful people in the industry. And look, I think it's easy to sort of denigrate the entire financial services industry as being, awful and corrupt. And look, there have been terrible things that have happened over the last 2 decades and more that, would give you a lot of evidence for those accusations. I'm not denying that, but I know in my experience, I've met a lot of great people. And I also think that when you're someone in this industry, who is outspoken and consistent in what you believe, even if people don't always agree with you, you find the good people, and you love to debate. I love to debate, and you find a lot of people that love to debate, and so it's very healthy, and that's what the comment file is supposed to be. It's supposed to be a healthy debate of the issues with evidence and data, and a way to help regulators get it right. And that's the whole, that is the purpose of the comment process, the comment period. And I think we're seeing that play out, and I love it. That's why, if you're a market structure nerd, this is it. This is like the Super Bowl,
Yeah, and the process is kind of, doing the legwork itself for weeding out the outliers. Like you said, everyone,
yeah,
majority of participants are doing this wholeheartedly, and with a real desire to see what, some change happen, whatever their vision of that is. But it's really helped to point out these extremists, as you put it, in some of the wholesalers. So
yeah, and yeah, I think that, like, when I look at some of the firms that are supporting the proposals, it's a really broad cross section of the industry. Like I'm saying, I think it's most of the industry is really coming together behind, lots of different parts of this. They're not going, they're not supporting everything, and they're really pushing for some changes. But like NASDAQ's comment letter, fascinating and very aligned, shockingly aligned with we the investors. And I know some of the people there who are their market structure people, very bright people, very, very grounded in data and research. I used to know their chief economist, the old chief economist at NASDAQ, and he was the same way, and just really thoughtful, frankly, about these issues. Interactive Brokers, a retail broker, the only one you're going to find in the file that's supporting the order competition rule.
Wow.
And not just supporting it, saying, one, this is a great idea. Two, we're not concerned about it because it's very well aligned with our approach to best execution. And three, here are some really creative ideas for improving it, and making it so it can't be as easily gamed and there won't be as many unintended consequences. Another one, XTX, one of the largest high frequency trading firms in the world, who came out again almost perfectly aligned with what we're saying with We the Investors in terms of tick sizes, in terms of the order competition rule. Maybe they're more in favor of, I think, the order competition rule than we are. IEX, the stock exchange. There's one organization called, I don't know how you pronounce it, NASA. It's the NASAA. So it's not the space agency.
Yeah.
But it's the state. What are they? The state administrators. So they're basically the state level securities regulators, and that's a very good organization to have behind you. Even FIA PTG. So that's like the high frequency traders, the group in FIA. That would traditionally have been an organization you would have thought would have been very opposed to this. And so it tells me maybe their membership is a bit different than it used to be.
But still so interesting because it just points towards this. I mean, some people would refer to it even as mafia behavior, the way Citadel and Virtue have handled some of, the things that they do. And that's heavy language and sort of extreme in itself. But you can't help but notice how everyone's just kind of saying, hey, if you can't play the game right and make money, then maybe that you're doing something wrong. And
yeah,
making them seem more extreme.
I think a lot of people are saying that, and a lot of firms who want to be able to compete on an open playing field, and want to see markets be a bit simpler and a bit more transparent, so that they can win on the merits, versus the current system where Citadel and Virtu get first dibs on 70% of all retail orders before they ever see the light of day. Another group that is broadly supportive, and again, I'm simplifying things, like FIA PTG. It's not that they're coming out to support everything, but they are saying that some of these ideas are good, and also maybe you want to stagger implementation, which is what we're hearing from a lot of people. Like Vanguard Cap Group, for example, huge asset managers, multi-trillion-dollar asset managers, saying, why don't we start with Rule 605 and NMS, and then let's see if the order competition rule is necessary. It's a reasonable view. I don't agree with it.
Right. It sounds like there's a lot of middle ground.
Yeah, I think I was talking about it with Alex, and he's like, what's most important from a legal perspective is reasonable people are disagreeing, and that's fine, right? It's healthy. Again, like I said, it's when you become unreasonable and you say, there's no grounds for this. You're outside of your legal authority. When you attack the regulator, it says more about your position, I think. And we're seeing academics disagree. Like Eric Budish, who wrote sort of a seminal paper on frequent batch auctions, is in the order competition rule file, talking about how auctions can be good. Chester Spat from Carnegie Mellon did some research with some indications that there may or may not be unintended consequences from auctions, and the regulator should consider that. That's a good thing. But then surprisingly, you have Robert Battaglio from Notre Dame in the comment file with some research. He got access to some data that nobody else has from a wholesaler. And his research is saying, no, this is a terrible idea, which is strange given his history of past research papers that have shown that brokers who route based on rebates or payment for order flow get inferior execution quality. So that's one of those weird things in the comment file. that
Not just weird, but that's where we start getting into the land of arbitrary and capricious, right? Where it's
right, a
you know
lot of
it's
flip flopping.
provable. Yeah,
Yeah.
you have evidence.
And then, the last one, I think that a notable supporter is ICI, the Investment Company Institute. So they represent $29 trillion of asset managers. And they came into the comment file and they didn't really express opposition to best execution or order competition, which is good. But they did say, hey, we have some concerns over the details. If you're going to implement these rules, here are some really important changes to make. And again, it's very constructive, good feedback. And then when you look at the opposition, besides, the ones you'd expect, Citadel, Virtu, and two other firms many people might not have heard of, Hudson River and Two Sigma. Those are sort of the four, and Jane Street, I should add, the four. Those are the five, I guess, wholesalers. But again, Citadel and Virtu are most of the market share. You find like three other organizations that I think are worth highlighting: the Chamber of Commerce, the Committee on Capital Markets Regulation, and SIFMA, which is the Broker Association. And when you dig into who is influential in those three organizations, it turns out to be Citadel.
Yeah, it comes right back to the same loud, noisy opposition.
Yeah. And so then they can be like, look, these independent associations or groups of experts are right aligned with our views. But it's like, of course they are, because either you fund them or you hold sway in them. And
right. I can't imagine the membership fees that Citadel pays to the Chamber of Commerce alone that gives them that kind of influence. It's easy, money talks. So I mean,
yeah, you're seeing a lot of that in the comment file, and I talked a bit on Twitter this week as I read through some of the comment letters before they were really flooding in, and I could kind of take them one by one. I was doing a better job of screenshotting and talking about them. Then they started coming in, and I just couldn't stop reading. But I think some of the things that Citadel and Virtu said in their comment letters are kind of funny, right?
Let's pull a quote out.
Yeah. I love this one. So one of the things that the very first tweet I put into my thread, I said from Citadel. Citadel said, by providing all other market participants with detailed information regarding the retail order awaiting execution in an auction, the order competition rule creates a mechanism that effectively licenses and encourages others to trade ahead of retail orders. Which is what Citadel gets today.
They can't cut in line because we already get to cut in line.
Yeah, they're like, oh, if you give everyone the information we get, you're encouraging them to trade ahead of retail orders. Now, they'll say, no, Dave, you're wrong. We have a best execution responsibility. There's nothing like that can happen. And, besides the fact that they've been fined $22 million in the past for doing exactly that, trading ahead of the customer orders, I think, the whole, one of the thematic arguments from Citadel and Virtu is we have a best execution responsibility if you send it to an auction, the other firms in there don't. But I really think they're leaning heavily on something that is very superficial, because they have the backstop of the NBVO, and that backstop will still be there, right? So the worst case scenario, Citadel Virtu lays off under the NBVO and provides that fill. Same thing will likely happen under the auction model. So, I find some of this stuff, and another quote where they're like, the commission is putting at risk the estimated $15 billion in price improvement delivered by wholesaler broker dealers today in order to reduce internalization and curtail the wholesale broker dealer business model. And my translation of that is, we are performing magic, and there's no way an open competitive system can provide the same outcome. Price improvement is bestowed upon retail by oligopolists, benevolent oligopolists, not arrived at by the free market.
Well, they don't want to throw a wrench in their spokes of their little magical system that they have going on, of their infinite money glitch.
It's a money printer. And I keep saying this, that another theme of the opposition to these rules is around price improvement and size improvement, and the fact that it can only be delivered through the wholesale broker dealer model and not through open competition for order flow, which I just find the premise philosophically absurd, because I happen to be a capitalist and maybe these people aren't. But the other side of it is, it just shouldn't be necessary. Why is price improvement necessary or size improvement necessary? Why don't we just want tight spreads in liquid markets? And then you don't
Right.
need any of that, right?
Right. I mean, that's the capitalist model, right?
Right.
That's how it works.
It's crazy to me because what, again, like you said, the meme that I keep tweeting out, which I don't know, it just tickles me. I think I find it so hilarious is, the internalization has destroyed the NBBO. Right, it's destroyed exactly as Ken
Yeah.
Griffin said in
Yeah.
2004. It's widened spread. So the very practice is why you need price improvement. If you get rid of that practice, spreads will compress, liquidity will increase, and costs to trade will drop, not increase. Price improvement is just a way of offsetting some of the cost to trade. But if that cost to trade isn't there, you don't even need price improvement.
It's a system that they've built themselves to try to convince us that the market can operate without, it sounds like.
Yeah. I mean, again, and it goes back to Bernie Madoff, and a lot of these rules go back to him and his influence back then. And so, again, arguing that we don't need to change these rules, just find it to be very disingenuous, obviously.
Yeah. Ken Griffin is this generation's Bernie Madoff. You can't change my mind, but that's just my opinion. That's not. Anyway, but so what happens next? I mean, you've got all of these different opinions coming in. Where does that go? Obviously, lawsuits are coming from some of the opposition, but how does that work?
Yeah. So right now, the SEC has to read every comment letter. They have to consider every comment that was received, and there are thousands of them. So that's going to take them some time. And ultimately, and we're gonna meet with the SEC over the next couple of months. I hope regularly. Talk to them about where they're at, what they're thinking. Present our case, as lobbyists and wholesalers and brokers will be doing on the other side. We're going to try and organize efforts to keep all of these proposals front of mind for people. Make sure they don't forget about them, that they know that this fight is going on, and now it becomes less of a public fight. Usually, it goes into the back rooms of the commission, sort of thing,
where it's more easily lost for opposition.
That's right.
With us, this side being the opposition.
Yeah, and so we're gonna do our best to make sure that is not allowed to happen. We're going to keep it as public as possible. Ultimately, I don't know when, 3 to 6 months would be my estimate, we will get a final rule proposal for each of these rules. So we currently have proposed rules, and then you get a final rule. And the final rule will incorporate any feedback that the commission thinks they need to incorporate from the comment letters. And then the commissioners will vote. And you need 3 out of the 5 commissioners to vote for a rule to adopt it. So then the rule's adopted, and then there's an implementation time. So of course it depends how complicated the rule is. Usually dictates how long the implementation time is. Like, one of the things is that the SEC is saying for the market data infrastructure rules, where they want to make odd lot orders visible on the SIP, for example, and change the definition of the round lot size. That was all part of the Reg NMS proposal. They want a 90-day implementation time period. That was actually in the proposal. And a lot of technical comments were filed saying that's way too short. It presents technical risk, and the infrastructure providers need 12 months to do it. So the SEC says 3 months. Some of the exchanges and the tech guys say we need 12 months. So we'll see what the implementation time period is. It's going to be different for each of the rules.
Recent history tells even up to 18 months that some of these things can be implemented. So that does seem
take
kind of an extreme deadline.
Yeah. Oh, for sure. And then so once the rules are adopted by the SEC, regardless of what the implementation time is, that's when the lawsuits can happen. And it's not clear, besides Citadel, Virtu, and likely maybe some of the retail brokers, who's going to sue over what. The exchanges have, NYSE especially has some pretty strong words in the comment file, pushing back on a lot of the changes that, again, NYSE supported years ago.
And you mentioned brokers. I saw even Robinhood was really strongly against that. Surprise! Everyone's shocked Pikachu face, right? But yeah, they were very vocal about their opposition. So.
Yeah, and so it wouldn't surprise me if Robinhood and Schwab are part of the case, because they are, I think, the 2 largest recipients of payment for order flow, and this would be the biggest change to their their business model. So, what will happen then is a set of firms will sue the SEC and try to get an injunction. And that's where I think things become a little clouded. They might get a preliminary injunction, but will that injunction stand? I don't know. I'm not a lawyer. I think this is, again, we should get Alex on here maybe next week to talk through some of these issues. But, what I think we should do is, we need to learn more about that process, but either the injunction will stand, in which case, the SEC won't be able to move forward with implementing some of the rules, or it won't, which is, I think, more likely that they will not be able to get an injunction because the SEC really did everything right that they need to do. And these rules are well proposed and well thought out. And they have, again, there's a lot of support in the comment file that the SEC can point to, both from individual investors, which is awesome, as well as from industry firms. So if that injunction doesn't stand, then even though the lawsuit is going forward, and that's a very long, potentially multi-year process, the rules will still get put into place, and that's what we want to see. And then I find it very unlikely that these lawsuits will succeed. It happens, but it's very rare. Courts usually defer to the regulator. That's the point of the regulator. They're supposed to be the experts, and as long as they do the analysis that they're supposed to do, which the SEC did, there's a lot of deference. And so then again, you're just, how long does it take to implement, and what does the 2024 election mean to all this? And that's going to be something we're going to inevitably have to talk about because it's likely going to run into either the implementation of the rules or the defense against the lawsuit or both. And so it matters who is appointing the chair of the SEC. It won't matter very much. And, not for nothing, if the largest donor to the GOP has his way, Ken Griffin, the SEC could look very different come 2025 than it might otherwise look. So,
right.
That's not to play politics or pick either side. I, personally, no one really, I don't know if you know much about my politics. I try not to talk much about it, but.
Absolutely. That's kind of a general rule within, sort of financial communities, is to keep the political talk out of it.
Yeah. And
irrelevant, but this is entirely relevant. I mean.
Right. And you're right. And I'm not trying to pick up one part. I think, frankly, political parties, much like the founding fathers, I think political parties are a disaster and horrific. And that's not even to say one is, the bad of one is the same as the bad of the other. But, again, just awful. Political parties
Absolutely.
are awful. The worst.
But regardless, the political climate and the, everything, the political outlook for the next year and a half is up in the air.
It
and
is.
We don't, staying proactive, not just with this, but, if you're not already registered to vote, register to vote and get involved and stay involved, because this directly affects these issues that we are starting to gain traction on. We're starting to gain ground. We've got a seat at the table. It's becoming a larger conversation. So staying involved in a lot of different aspects that we don't cover today, that's so important.
It is. Honestly, there's just, that's, I think the philosophy behind We the Investors is just to empower people, make sure your voice is heard, that other people aren't allowed to speak for you. The same thing, of course, is true for voting. And, there's no way around the fact that if by some crazy set of, occurrences, Ken Griffin ends up being Treasury Secretary of the U.S., you can certainly imagine what the SEC is going to do with these rules.
What a cursed set of circumstances that would be. I mean, then you couldn't deny that America's just an oligarchy in a sheep suit. But anyway, we're running out of time, and we won't get into all of that. Anyway, well, is there anything coming up in the next week or so that you think we should watch out for? Just keep coming, these comment letters keep coming out, and we'll be tweeting about it.
I would just say, just hang out in the comment file, read the comments. This is sort of the beauty of the regulatory process at work, and I think it's great to see that, especially if you're listening and you haven't really been a part of this or seen it work before. if you filed a comment letter, you're part of the process, and it's great to read what other people are saying and what the firms are saying. And I think we'll talk in more detail next week, after I've actually taken notes, and we get a lot more comment letters in. I think the SEC is still well behind. So when I see We the Investors comment letters, I'm seeing a count of somewhere around 4,400 letters now filed. Yeah, between Order Competition Rule, NMS, and the two NMS, and the NMS Best X letter, and then the other NMS letter. So I think they're behind. So I can't wait to see what the final number is, like we talked about last week.
But already, cheers to that.
It's wild. It's amazing to see it.
You can't miss that.
Yeah, and so I think we're just going to be talking a lot about this, and what else is going on in markets. I mean, we're past. It seems like we're past, or at least we're in the eye of the storm for the banking crisis. You don't see banks going out of business this week.
Right. It is sort of happening on a week by week basis. So by the time by next week, we may already be in the middle of a bank run.
Right. So, I'm hesitant to make forecasts, but I see some people online talking about how things seem to be loosening it up rather than tightening. So that's, look, I don't want a banking crisis. I don't want one that goes out of control. So I hope that this one has been contained. I think there's a lot going on in the crude oil market, both geopolitically and as usual from a markets perspective. So there's all sorts of interesting things in markets right now. For me, market structure is where I'm paying attention. But I think in the comments, please let us know what you want us to talk about, and the things that you want us to cover. And I think we'll do as good of a job as we can with those. I think we're not going to talk too much about individual securities. I don't think that's what we're here to do, but of course lots of people want us to, and we'll try and hit on some of those issues from time to time. So
yeah, definitely. So we're I think that's a good way to put it. We all have our favorite, our pet securities, I think, and our issues that we that we're advocating for, all within the broader umbrella of just fighting for more fair markets. So
yeah, that's right.
That's what brings us all together here and interested in talking markets. But we do try to keep this at about 30 minutes. It looks like we're out of time for today. But thank you for tuning in to Let's Talk Markets. We hope you enjoyed the show. Be sure to subscribe to our podcast. You can follow us on Twitter. David is definitely a lot more active on Twitter than I am, so he's at DLauer. We the Investors is also on Twitter. You can stay up to date on proposals, comment periods, and other avenues of activism. And you're welcome to leave suggestions, like you said, for future shows, which will be posted every Tuesday. So that's all we've got for this week. Thank you for tuning in. Until next week.
Yep. Thanks for listening.
Thanks. Bye, guys.
Bye.